Now, the unemployment rate is also expected to inch down to 3.7%. We'll also be keeping a close eye on wage growth, which showed signs of moderating last month. Joining us now to break it all down, we want to bring in Eric Freedman, U.S. Bank Asset Management Group Chief Investment Officer. Eric, great to see you here. So I know you guys, you were going through some of the top questions that you're getting from clients right now. And one of them is around the labor market and when you expect to see the labor market normalize. What is this number? What do the latest readings tell you about where the labor market stands?
Yeah, Sean and Brad, great to be with you. We'd say that this remains a resilient economy, and the nexus of that resilience really rests in the labor market. And whether you look at some of the claims data, obviously the ADP number, the JOLTS data, there's still some stickiness of demand for employers to find workers. It remains, especially for small businesses, a tough environment to keep people in chairs. So what we think that means is that wage growth is probably still risk to the upside as opposed to the downside. And clearly the trend has been for a slower rate of increase, which is really what the Fed wants to see. I think what has markets a little bit concerned right now is that rate of change is just not great enough. In other words, we're not seeing a significant downturn, and that's been, again, a bit inflationary. That's been some of the concerns that we've seen very persistently across markets in the current environment.
Yeah, Eric, that's a great point, and especially considering the employment situation and how that marries up with consumers, their confidence, the sentiment, or even expectations. You know, I kind of harken back to the Conference Board most recent consumer confidence reading that said the employment situation regarding this, slightly more consumers saying jobs were plentiful, also saying that they were harder to get. But we've also been looking at, especially as our own Josh Schaefer pointed out a couple days ago, the narrowing for people who are jumping jobs or going elsewhere to try and find a bump in their salaries as well. That plays into the wage picture, which also gets back into the discretionary income. So all of these things considered, typically people would have been opting for those new jobs to try and get a significant bump to outpace their costs of living or, you know, other things that they wanted to get. How is that having a larger impact on sentiment or confidence among consumers from your purview?
Yeah, those are great points, Brad. I think that the essence of it is simply this, that the low-hanging fruit of what's called the job market arbitrage, people that were going from position A to position B for a 10, 15, 20% wage increase, that's not totally done, but that's largely behind us. And I think that, you know, you've seen the ratio of job openings to job demand being at roughly 2 to 1, now down about 1.5, 1.4 to 1. So that doesn't sound like a huge difference, but that does certainly add up over time. So I think this is good progress in terms of maybe a normalization of labor market trends, but by no means are we at levels where wage growth will be subdued. So again, back to the idea of this very sticky, very persistent inflationary environment. 2% is what every central bank around the world, not every, but most central banks around the world want. We're still far away from that. Whether you look at headline inflation at, let's call it 3.25, that's obviously a far gap between those levels and 2%. So I think that has the Fed's attention in terms of the need to really bring those measures down. They'd like it to happen more gradually. And again, the interest rate environment is certainly pressuring the consumer to, again, think about their spending trends as well as what they're thinking about with future employment opportunities.